Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. In this video, I'm going to talk about how to invest like Warren Buffett in a bear market, specifically in a high inflation market. I wanted to make this video because the market is down a lot this year. Many investors have not experienced this large bear market before. For example, at the time of making this video, the S&P 500 is down more than 20% from the most recent peak, and the Nasdaq is down more than 30% from the most recent peak. In my opinion, Warren Buffett is the most successful value investor in the world. His investment holding company, Berkshire Hathaway, has outperformed the S&P 500 significantly since he took over the company in 1965. In fact, during the great inflation period in the 1970s and early 1980s, US inflation reached as high as 14%. Berkshire Hathaway did well compared to the S&P 500 during this period. I believe you can learn a lot from Warren Buffett, so in this video, I'm going to share with you Warren Buffett's most important investment principles. I will cover these topics in this video. First, why be a business picker and not a stock picker? Second, why buy more dividend growth stocks? Third, how to be greedy when the market is very fearful. Fourth, why have a very long investing time frame? Fifth, why never bet against America? And sixth, what is the best investment in a bear market? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. If you're a long-term investor, the first investing principle is be a business picker and not a stock picker. There's a huge difference between investing in stocks versus investing in businesses. The mindset between a business investor and a stock investor is very different. Contrary to what most people think, Warren Buffett is a business investor. He is not a stock investor. Warren Buffett wrote this in his 2021 shareholder letter. Berkshire owns a wide variety of businesses, some in their entirety, some only in part. The second group largely consists of marketable common stocks of major American companies. Additionally, we own a few non-US equities and participate in several joint ventures or other collaborative activities. Whatever our form of ownership, our goal is to have meaningful investments in businesses with both durable economic advantage and a first-class CEO. Please note particularly that we own stocks based upon our expectations about their long-term business performance and not because we view them as vehicles for tiny market moves. That point is crucial. Charlie and I are not stock pickers. We are business pickers. Then in Buffett's 1989 shareholder letter, he wrote, when buying companies or common stocks, we look for first-class businesses accompanied by first-class management. Warren Buffett learned value investing from his teacher Benjamin Graham. Graham wrote this in his famous book, The Intelligent Investor. Investment is most intelligent when it's most business-like. It's amazing to see how many capable businessmen try to operate in Wall Street with complete disregard of all the sound principles through which they have gained success in their own undertakings. Yet every corporate security may best be reviewed in the first instance as an ownership interest in or a claim against a specific business enterprise. And if a person sets out to make profits from security purchase and sales, he's embarking on a business venture of his own, which must be run in accordance with accepted business principles if it is to have a chance of success. Buffett likes to buy pieces of wonderful businesses at wonderful prices. He likes to invest in businesses he can understand that have great economic advantage and that are run by first-class CEOs. Also, Buffett is a value investor. He will only invest in a business when it is at a fair price or when it is undervalued. Here's the important part. Contrary to what most people believe, Buffett invests in stocks the same way he buys businesses. He does not trade stocks. Instead, when he invests in stocks such as Apple, Bank of America, Chevron, Coke, and American Express, he invests as though he's buying the entire business. When his top holdings become undervalued, he likes to buy more shares because he wants to increase his ownership of his favorite businesses. This is why he always says, too much of a good thing can be wonderful. Warren Buffett's favorite holding is forever as long as the businesses he invests in are outstanding businesses run by great management with favorable economic advantage or economic modes. If you look at Buffett's 300 billion stock portfolio here, you can see his top holdings are Apple, Bank of America, Chevron, Coca-Cola, American Express, Occidental Petroleum, and Kraft. All these top holdings make up about 80% of his stock portfolio. Buffett has invested in many of these top companies for many years already. Many of his top holdings are multi-baggers. Most of them are dividend growth stocks and not hyper-growth stocks. Here's another important part. When Buffett invests, he does not care how the stock will perform the next day, next week, next month, or next year. This is very different from most investors. Most investors invest in stocks when they believe that stock prices will go up further, and sell stocks when they believe that stock prices will drop further because of a micro and macro catalyst. Buffett mainly cares about business performance over the long run because he knows that business performance such as free cash flow growth matters the most in the long run. Buffett makes the most money by buying businesses that generate large free cash flows and by owning shares or pieces of wonderful businesses such as Apple and American Express that are run by first-class management and that have great economic moats and great long-term business prospects. This is why Buffett said, if a business does well, the stock eventually follows. He also said, I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. The second principle is to buy more dividend growth stocks instead of hyper growth stocks. Here's why dividend growth stocks are better than most hyper growth stocks over the long run. When it comes to investing, we have to understand the potential risk and know how to manage risk. Dividend growth stocks in general are much less risky than hyper growth stocks, especially when inflation is high, when interest rates are increasing quickly, and when we are in a bear market. Generally speaking, dividend growth companies tend to be much more well established, have better finances, and have much more consistent free cash flows than hyper growth stocks that are not profitable yet. To be fair, hyper growth stocks tend to perform much better when inflation is low and when interest rates are low. But the opposite is true. Hyper growth stocks are most risky and often perform the worst when inflation is high and when interest rates are increasing quickly. Warren Buffett's Berkshire Hathaway mainly invests in dividend growth businesses. Also, the S&P 500 has many dividend growth businesses. In comparison, Cathie Wood's ARK ETF mainly invests in hyper growth stocks or innovative businesses that are often not profitable yet but have a lot of growth potential. If you look at this past 5-year performance here, you can see Warren Buffett's Berkshire Hathaway even outperformed the S&P 500 ETF and Cathie Wood's ARK ETF. If you look at Warren Buffett's $300 billion equity portfolio here, you will notice that most of his top holdings are very well-established dividend growth businesses such as Apple, Bank of America, Chevron, Coke, American Express, and even Occidental Petroleum. I said this earlier, Warren Buffett looks for two main characteristics in a wonderful business. Buffett likes to invest in wonderful businesses that are run by first-class management and that have great economic advantage or economic moats. Also, Buffett likes to buy pieces of wonderful businesses when they are undervalued. I'll give you two examples here. Apple and American Express are two wonderful businesses Buffett invested in. Buffett invested in Apple and American Express when they were undervalued. In my opinion, these two companies have excellent brands. They have large moats that cannot be easily copied by competitors. They have consistent revenue growth, free cash flow growth, earnings per share growth, and dividend growth over time. They also use their free cash flows to buy back shares almost every quarter. The third principle is to be very greedy when the market is fearful and be very fearful when the market is greedy. This is very hard to do because no one knows when the market reaches the bottom and when the market reaches the peak. Not even Warren Buffett or Charlie Munger can predict the market bottom or the market peak. Buffett said this in a shareholder meeting.
The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. We have never made, Charlie and I don't think, in all the time we've worked together, and I'll tell you something later on maybe about how learning takes place, but we have never, I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know. Wrote an article for the New York Times and Buy America and all these things. Well, if I'd had any sense of timing and waited 6 months until, I think the low was in March, and in fact, I think I was on CNBC maybe that day or something, but I totally missed that opportunity. I totally missed, in March of 2020. We have not been good at timing. We've been reasonably good at figuring out when we were getting enough for our money. And we had no idea when we bought anything Well, we always hoped it would go down for a while so we could buy more, and we hoped even after we were done buying and ran out of money that if it was cheap, the company would keep buying, and in effect taking our interest up. I mean, that's stuff you could learn it in fourth grade, but it's not what's taught in school. And we haven't ever timed anything. We've never figured out insights into the economy. When I was 11 years old, March 12th, I guess, 1942, March 11th, I bought stock when the Dow was 90, well, it was 101 in the morning. It was 99 at the end of the day, I think. And, now it's 34,000, or maybe it's 1,000 less than it was on Thursday. But, it's one decision that it's a good thing to own American business.
Warren Buffett and Charlie Munger said that they cannot time the market and predict the market bottom. Instead of timing the market and trying to predict the market bottom or trying to predict the market peak, I believe one of the best ways to invest is to always invest with a good margin of safety, especially the market is in a large correction. Investing with a good margin of safety means only buying shares of a wonderful business when the stock is traded below its intrinsic value, so it can reduce the downside risks. For example, I will use Apple as an example here. If you want this intrinsic value calculator, you can download it from my Patreon blog in the video description. I understand Apple's business very well, so I'm able to calculate Apple's intrinsic value based on its free cash flows, discounted to the present day. In this intrinsic value calculator, I'm assuming Apple's free cash flow will grow at a compound annual growth rate, CAGR, between 5% and 10% over the next 5 years. Then I discount Apple's future free cash flows to the present day to calculate Apple's intrinsic value, or how much Apple is worth right now. There are 3 case scenarios here: worst case, normal case, and best case scenarios. Now, based on my intrinsic value estimates here, I believe Apple's intrinsic value is $139 per share. This intrinsic value will change over time depending on Apple's future earnings and future free cash flow growth. Personally, if I want to invest in Apple, I will want a minimum 10% margin of safety to reduce the downside risk. This means I will buy more Apple if the stock is at $125 per share or lower. Similar to Buffett, I believe Apple is a wonderful business with first-class management, a great economic moat, and great long-term prospects. Benjamin Graham said this: in the short run, the market is a voting machine, but in the long run, it's a weighing machine. The fourth principle is to have a very long investing time frame. The main reason is that no one can predict the stock market in the short term. However, US stocks in general, such as the S&P 500, tend to perform very well over the long run because of the US long-term economic growth. Also, in the short term, the market is a voting machine. This means stock prices always go up or down depending on market sentiments. The market can be very greedy, fearful, or irrational in the short term. In the long term, the market is a weighing machine and is much more rational. This means stocks always go up or down in the long run, mainly depending on company fundamentals and business earnings. Warren Buffett wrote this: in fact, when we own portions of outstanding businesses with outstanding management, our favorite holding period is forever. We are just the opposite of those who hurry to sell and book profits when companies perform well, but who tenaciously hang on to businesses that disappoint. Peter Lynch aptly likens such behavior to cutting the flowers and watering the weeds. Warren Buffett does make mistakes in his investments. Based on what I know, some of his biggest mistakes were investing in Wells Fargo, IBM, Verizon, and GM. For example, if you look at this here, you can see Buffett sold all of his holdings in Verizon and sold a large position in GM. Normally, Buffett sells his stocks when he realizes that he made mistakes in his investment thesis, or if the businesses he invested in are no longer outstanding businesses, or if he wants to free up more cash to invest in better opportunities. Buffett wrote this: I make many mistakes. Consequently, our extensive collection of businesses includes some enterprises that have truly extraordinary economics, many others that enjoy good economic characteristics, and a few that are marginal. One advantage of our common stock segment is that, on occasion, it becomes easy to buy pieces of wonderful businesses at wonderful prices. That shooting fish in a barrel experience is very rare in negotiated transactions and never occurs en masse. It's also far easier to exit from a mistake when it has been made in the marketable arena. If you look at this market cycle here, you can see the best time to sell is when the market feels extremely greedy and euphoric. This is when most stocks are overvalued and are traded well above their intrinsic values. The best time to buy is when the market feels very depressed and hopeless. This is when most stocks are substantially undervalued and are traded below their intrinsic values. The fifth principle is never bet against America's long-term economic growth. This from CNBC. Buffett recommends most investors invest in low-cost index funds such as the S&P 500 over the long run. Keep buying more, especially when the market is down, and hold for the long term.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. You know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8% and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
In my opinion, if I don't want to pick my own stocks, I believe one of the best ways to long-term investing is to simply keep buying a very low-cost S&P 500 index, have a monthly or quarterly investing plan, buy more when the market is in a bear market, and hold it over the long term. Similar to Buffett's thinking, I believe the S&P 500 will continue to perform very well over the long run because of America's long-term economic growth and because of the S&P 500 company's long-term earnings growth. Also, most fund managers cannot outperform the S&P 500 over the long run, so I think it makes sense to just buy a very low-cost S&P 500 index over the long run and keep buying it over time, especially when the market is down. So what is the best investment in a bear market? Regardless of the economy or how well the market is doing, the best investment is investing in yourself. This means becoming exceptionally good at something, such as a profession or a business, that is very valuable in the marketplace. The marketplace will always pay you whatever amount of money that matches your service and how valuable your service is, even in a recession. Warren Buffett said this when he was asked what's the best investment in a high inflation market.
The best thing you can do is to be exceptionally good at something. If you're the best doctor in town, if you're the best lawyer in town, if you're the best whatever it may be, no matter whether people are paying you with $1 zillion or paying you, they're going to give you some of what they produce in exchange for what you deliver. And if you're the one they pick out to do any particular activity, sing or play baseball or be their lawyer, whatever it may be, whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. Somebody else will give you some of the wheat they produce or the cotton or whatever it may be, and they will trade you for the skill you have. So the best investment by far is anything that develops yourself. And again, not taxed, so that's what I would do.
I got some advice for you too. When you have your own retirement account and your friendly advisor suggests you put all the money into Bitcoin, just say no.
Nobody can take away from you the talent you have. I mean, and the truth is that the world will always be willing. They'll need to do something, and some people will not have skills, and they will get less of the product of the society than somebody who has other skills. And sometimes that has something to do with education, but a good bit of the time it doesn't have anything to do with education. I mean, but figure out what you'd like to be, and figure out how, and what you'd like to be is what you're going to likely be good at. And you stumble in to what you really like doing, what you're good at, what's is useful to society, and then it doesn't make any difference whether the dollar bill, is now worth, in terms of the purchasing power, a cent or a half a cent or a hundredth of a cent. If you're the best doctor in town, they'll bring you chickens, whatever they may do, but they can't take it away from you. The best protection against inflation, though, still is your own personal earning power. If you play the violin very well, you will do reasonably well. during inflation. I mean, it's play it better than other people. People will pay you for doing that if you all kinds of things. So your skills will not be taken away, and your money may be.
Developing your own skills and become exceptionally good at something are the best investments you can have because the marketplace will still pay you whatever amount of money that match your service, even when inflation is exceptionally high or when the economy is in a recession. Personally, becoming exceptionally good at something is one of the most important life lessons I have learned from Warren Buffett. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.